Hi everyone, welcome to the Private Banking Wealth Management Hotseat. Today we have with us David Wager. Thanks David for making time. David is an expert in the area of wealth continuum at Synpulse, and we look forward to a very interesting conversation with David the next few minutes.
Thank you for having me.
David, to get the conversation started, I know wealth management or assets under management is a huge market overall globally, right? And at the same time, if you look at asset penetration that the banks and the wealth managers actually have, is 25% if you look at the highest tier, and even goes down to even 10% when it comes to the money that's being professionally managed. So, and if you could maybe highlight aspects of why wealth continuum as a topic is being spoken of quite often these days. What has actually changed or what is changing, and why wealth continuum becomes an important aspect for us to discuss about.
Yeah, it's a good starting question. I think we often talk around the wealth continuum, and sometimes we're having these conversations with our clients as well. And there can be a slight gap in an understanding of what it is that we mean. When we're talking internally at Synpulse, we really discuss this as the difference in the wealth tiers. And the concept of the continuum part is that how you engage that client through from their first investments all the way through to them potentially becoming a high net worth or ultra high net worth individual as well. And making sure that you can nurture that relationship, you can sort of adopt the kind of services and the products that you're offering to them so that they have that continued management as they grow in their own assets as well.
Understood. So what are the trends? Why is there so much emphasis on it? Because that traditionally would have existed even many years ago. So what is changing that rapidly that it becomes becomes an area of attention?
Yeah, so if you look at the current model, and it's been in existence now for a little while, where you see quite clear segmentation between the tiers. And a lot of banks will either have a retail segment, then they may service some form of mass affluent client, and then they'll have a separate private bank to cater for those high net worth and ultra high net worth individuals. And there are many historic reasons for this. It made perfect sense. And there were some recent surveys conducted where I think up to sort of 90% of the RMs that were interviewed said that having this segmentation is imperative to their business because it allows them to better serve the clients that they have. And the firms that were, when they were asked the same question, said, actually, this is critical for us because it allows us to efficiently allocate resources as well around our firm. So really the history of having these clear segmentations was in those two parts: better client service and an ability to be able to run your business. I think what we're seeing changing is in two parts. First is that technology is continuing to evolve, which means that those goals can still be achieved even with a slightly more, expanded understanding of those different segments, maybe a gray or a blurring between how those segments and those tiers are applied. And the second one is on your actual client's preferences and the way that they manage their investing. So if we look at the technology side to start, we have improved digitalisation of processes, which means that the overall cost to serve of clients is being reduced. This is coupled as well with efficiencies that are being seen in your back office processes. We're also seeing the application of this technology to be able to provide improved personalisation to clients. So where historically clients may have been given a cookie cutter approach if they were a certain type of tier, we can now start to personalise that as well, even further down into those wealth tiers where it may have previously only been the reserve of your high net worth and your ultra high net worth. So that's the kind of digital technology side that's playing a major role. The other side is in actual personal investments. So if you go back and look historically and you spoke to your wealth advisor, it was all around investments. That was what led the conversation. So what are my returns to the market? How am I performing? It was the sort of targeting or the aim for increased returns. And as we saw new products come in, I think, back in the early 90s, the introduction of ETFs, you could buy the whole market. So that happened in 93. And then as you got into the 2000s as well, into 2008, 2009, a lot of individuals got burnt in this pursuit of that return and just focusing on the investments. And this is where we started to see that pivot towards goal-based investing, and clients really saying, actually, I have certain specific goals in my life that I want to pursue. How can you help me with those? And so that kind of change in approach, as well as the technology, has meant that we're starting to see that breakdown of those specific tiers and how these firms are actually servicing their clients.
Excellent. So you mentioned goal-based investing, and is there a specific segment or a wealth tier of the market, as you termed it, that we should look at, or is it more a broader concept? And how does it work if you consider the richest of the rich client, ultra high net worth towards affluent and everything, keeping goal-based as one of the areas? Do the clients need change? There is also a concept around high touch, low touch, automation, technology. Could you maybe give an appreciation from a client servicing standpoint? How do the needs evolve, and how does it touch the aspects that you mentioned on transformation, digitization, and so on?
Yeah, so I think the term goal-based investing is one that, I mean, is more deeply rooted in the actual investment hypothesis and the philosophy and how it works. And there's a lot of math space behind on how this actually can be applied in practice. But from a client's perspective, it's very simple. It's in, I have a clear goal, and if you are if you are newer to the investment world, you may be looking to save to purchase your first property. You may be looking to save to pay for your child's college education or something along those lines. And that is something that is specific maybe to that particular tier. But overall, it doesn't change as you grow with your wealth. You still have these specific goals. It's just that the actual process and the planning and what you need to discuss with your advisor changes. So as you move into your high net worth and your ultra high net worth, typically these are clients who are later in years. They're probably thinking about handovers. They're thinking about philanthropy. They're thinking about the next generation. So their goals are still very applicable. They just change. And when we apply this then to answer the second part of your question around how the technology is being put in, they're really just to say, how do we allow ourselves to meet those goals and work on those goals with the client collectively? So you're no longer operating in isolation as an advisor or in isolation as a client, but rather you're working together to be able to meet those goals. And some of the technology that we're seeing now that's being employed is really allowing those clients to have a more active approach or a more active engagement with their advisors, but focused around those goals rather than just the investment percentage that they're getting on their assets.
Understood. And now that wealth continuum ranges from, 100,000 of investable assets goes to the ultra highs with billions of dollars. Where does the cost to serve digitization, automation, and a lot more bespoke needs from a client standpoint? So if you digitization is one aspect, does it address all tiers equally? Or there comes a point in time where you have to really think about costs to serve versus the revenue and the service model and the segment. And how does one transition in the space of wealth continuum?
Yeah, there's no easy answer, I think is the short answer. Maybe a good way to address this question would be to explain a little bit of how we work with some of our clients that are looking to move into some of these tiers. And we often work with them and we see the same recurring challenges. So normally when we're engaged, some of the banks have already started to work with some of these tiers, and they are potentially moving in more into the mass affluent. They just haven't yet been able to crack the code to actually, as you said, to manage that gap between the revenue that's being generated and the cost to serve as well. So we see frequent challenges, and some of these are that from a technology perspective in their own bank, they have siloed technology. They may be applying different technology stacks to service their private banking clients to those in their mass affluent market. This in then turn means that it's not scalable, and the impact to the client is actually a reduced experience as well. The second part is around the segmentation and how they look at those tiers. We see examples where whilst the actual tier may have a different name, you look at it and it's hard to distinguish maybe between the two tiers and what is changing from a client experience if they are to move from one tier into the next tier as well. And this is also then coupled with actual contradictions in some of those tiers. You may see a client being upgraded from a certain tier, maybe if they're a mass affluent client and then they become a accredited investor and they're moving into the high net worth space, they may actually lose access to some of the tools and the services that they were already used to. So you need to make sure that you can address these points as part of that. And when we go through these challenges then and we work with the bank, we really ask the questions of how do we ensure we find that balance between making sure you have a scalable system that allows the cost to serve of your clients to always be in line with the amount of revenue that's being generated. And often what we find is that if we're moving towards those high net worth, ultra high net worth clients that you've mentioned, that a fully digital approach isn't quite going to make the mark. And actually the hybrid approach is something that's still going to be best placed. But if you can provide that high net worth client with the opportunity or the option to digitally serve, then that can be an improved experience for the client, even if they know that they've got the RM there in the background that they can work with. As you move further down the tiers, though, to keep that cost of service at a level that works, you're going to be looking for an increased number of digital touch points and fewer in-person touch points.
So if I understand you well, so wealth tiers probably need not be the only way or even the primary way of how do you look at wealth management needs of clients. So, and if it's not the only way, what other ideas would you suggest, or what other ideas are banks implementing, is the industry implementing, that helps them tackle the problem around boxing clients on the wealth tiers?
Yeah, so if you ask anybody how primarily you look at a bank, you go on their website today and you'll see different tiers, and they'll say something like, if you have $2 million US dollars in available liquid assets, give us a call and you can join as a private banking client. Or if you have X number of assets. So it's still very much driven by your AUM. And I think where we've pivoted from is that no longer reflects the client that you're actually serving. This takes me back to my earlier point around those goal-based investing, fully and actually understanding what it is that your client needs and allowing them to meet their goals. Maybe we don't need to segregate the clients by their AUM, but rather we need to look more holistically about what it is that they're trying to achieve, and also their propensity to actually look into some of the products and the options that you have. So this as well then is being managed by things like financial education and financial literacy. And then all other aspects of that client, so not just their AUM, but their interests, their hobbies, their appetite for risk, all of these factors coming in to help you actually understand what that client's tier would be. So more focused around making sure that you're able to meet the client's goals and their expectations rather than just boxing them into a specific tier.
Understood. So this would mean that you more start to focus on value proposition towards the clients and having a more client needs-based segmentation when it comes to servicing the clients, instead of just normally looking at wealth tiers and how much assets that they hold.
Yeah, that's my exact view. And I think that's the way we're heading. And the pivot for me is that the way that people are consuming their advice as well is changing. And we've seen the proliferation of passive products and low-cost products. I think at least here in Singapore, we've seen an increase in the number of digital wealth managers that are providing low-cost access to investments. And this topic then of, okay, well, how do we actually manage and build that relationship with the client to provide that advice is potentially changing as well. We're starting to see an increase in people consuming their interests or their ideas for investing or their goals coming from other places as well. So we've recently been looking at this term of like fin-social, and sort of social financial knowledge is coming around as well. And I think all of these aspects are going to play into a more substantial change in how clients should be, or how sort of the bank should be approaching their clients in terms of their tiering, to make sure that they can bring in all of these components. And like I said, rather than just allocating them to a single wealth tier.
Interesting. You mentioned banks at the same time. You also had a word around. I'm not sure if it's digital wealth managers or wealthtechs. How do they play in the landscape on wealth management and service offering and everything? So, and what type of clients do they attract? And how do you see them compared to banks that are offering, similar or comparable services?
Yeah, so I mean, just for some of our listeners, in a bit more context, we've based here in Singapore, but also happening globally, is that this focus on fees and the introduction of low-cost service offerings, which are being provided to clients who are maybe just starting their investment journey or who are looking to do some of this in a self-service way, at least initially. And from what I'm seeing is that a lot of these companies are targeting those who maybe don't have a relationship manager today. They don't have an established account with a well-known private bank or with a local bank, but with a relationship manager assigned. But they want to start that investment journey. And very much focused on fees. I see a lot of the content being focused around this is the impact of a 1%, 2% charge. I think the way that they can operate in parallel and in conjunction is that they do offer slightly different services as well. There are limitations that are provided by some of these firms, at least now. Yes, they can give you the access to some of the products and you can get low access costs to some of the funds. And some of them are even offering things like the retro session coming back to the clients as well to lower their costs. Where maybe they won't yet have that availability because of the licensing is things like availability of margin, availability of loans, etc. as well. So I still think there's at least for now an opportunity for both of these to work in parallel. I think what makes it interesting for me is that this has only happened over the last 5 or 6 years, at least in any real numbers. And at least when I'm talking to some of my colleagues and some of the clients as well, these are now becoming household names. And what I don't know is how they're going to continue to evolve over the next 5-10 years and whether or not they might start to introduce these products if the licensing allows so that they can start to compete with these private banks. And I think that would be an interesting space. And I mean, a personal opinion is just one that we're going to see an increased focus again around fees, especially in APAC, and an understanding of what a fee may do to you if you're looking at long-term investing.
So if you look at the ultra high space, that's probably if I understand the market right, it's really bespoke, high value services. It requires a large team to service these clients and so on. And then the lowermost is more digital, digital banks, retail, simpler products. And the middle space is where the battle is going to be fought, if I understood you well. So with the wealth techs of the world that are trying to now capture the assets and the AUM with lower fees, better technology, better capabilities, banks are also trying to up their game. And potentially, I'm trying to understand what would be the things that differentiate one or the other providers from a client's needs standpoint. Is it more to do with the technology ease of use? Is it more to do with the fees? Is it more to do with the relationship? Or do you see all segments grow equally, or there is going to be one or the other winner in this fight?
So we had a look at some of the numbers before we came on, and there was a recent report in Singapore that spoke about the growth of wealth and liquid assets. And what really struck me about this is that in Singapore, as of early part of 2024, there are 30 billionaires. There were just over 300 centimillionaires. When you looked at those in the population that had over $1 million in liquid assets to invest, that number reached 250,000. And that's a significant market. And that is well worth playing for. I think to answer your question about who's going to be successful in that, it's those that can have very digital products that allow for ease of use. They have the tooling that allows people to apply their own goals and to see how they can reach them. But then supporting that with the back-end technology that says, here's a portfolio that could work for you that will allow you to meet that goal. It's the right risk base, it's the right returns expectation, and it fits your timeline as well. And I think that's going to be a major component. And supporting that with then the right products and making sure that you can provide these products to the clients at the right time is going to be critical. The part for me though around the advice and the relationship, I don't think is going away in any way. If anyway, I think this is actually going to become a larger part, where I mentioned it earlier around this like social finance and sort of group understanding of and around financial literacy as well. And I think this is going to become a bigger part too. There was a study just a couple of years ago where, when again looking at APAC, where it's typically deemed to be a little bit more execution only and very limited appetite to pay for advice. So actually 40% of those that were surveyed came back and said that, yes, I'm ready to form my own views on how I want to make my investments to reach these goals. But what I do want and what I'm willing to pay for is somebody to stand behind me and say, that's the right decision. You've done the right thing. So it is advice. It's exactly that, right? They're just saying, yep, I can confirm that your decisions are going to be the right ones. So I think it's going to be a combination of all of those factors that's going to be the firm that really is able to take this forward. Over sort of well-established product, the opportunity to be able to get your own convictions validated, and then having the access to the products and that allows you to see that you're going to be able to meet your own goals.
Excellent. Thanks a lot, David. So we are towards the last section, maybe the final one or two questions. Want to keep it as open as possible. So any trends, any specific takeaways, anything that you observe in the industry that you want to share in your final words or thoughts?
Maybe from more of a personal level. I mean, I have a sort of deep passion in financial literacy and investing, and probably the wrong place, but sort of targeting early retirement as well with my own goals. And I think this has been an interesting thing, because for me, I see conversations moving away from the wooden paneled rooms of sort of private investor relationships and with your sort of investment advisor to being more open and being more broad. People are happy to talk about their finances. They're a little bit more open in talking about their own investment objectives and what they want to achieve. And there was a recent study conducted by the CFA Institute in the US, but the numbers were very similar across the rest of the world as well, where 80% of Gen Z that were interviewed said that they started investing before the age of 21. And that struck me, because that wasn't the case for me, and I think for some of my peers it wasn't the case. But when I talked to some of those, the younger guys in the firm, these conversations are starting earlier, and people are well aware that the easy path to success in your investing is to start early and let time be your friend. And I think that's a trend we're going to continue to see. So again, I think if I was one of these firms, what I would look at is making sure that I have an offering that resonates, that appeals, that can be understood by this demographic as well, so that they can start their investment journey and you can build that relationship from an early stage.
Wonderful. Thanks for the closing words. Was quite insightful, the last section of it, especially on early retirement. So David, thanks again for your time. And towards the audience, if you believe there are specific comments, or if you have certain topics that you still like us to address, maybe in a future session, please do let us know, and we look forward to hearing back from you. Thanks a lot, David.
Thanks for having me.